Hi, here we are mid-year already. And like last year, it's not turning out quite as badly as analysts feared. US growth has beaten expectations, as did some key emerging markets. Even so, the continued deluge of bad news is unsettling as we move into our summer breaks. Is there an antidote? Well, once again, we have Peter Hall, and he's going to revisit a well-worn issue of the value of market diversification. This time, though, from a different and more creative angle. Peter hits us with some powerful what-if scenarios. However, these what-if scenarios are born out of a select number of actual exporters. What if a company had been more diversified into fast-growing markets back in 2002? How might that have changed their overall performance today? Market diversification is a long-term strategy, and the value of market diversification can be seen in this video. Have a listen, and over to you, Peter.
Well, thank you, Caroline. After a pause, I'm really glad to be back with this next economic briefing, and it's a zinger. Back in the early 2000s, there was a lot of enthusiasm about globalization and how technology was revolutionizing trade and supply chains. Analysts, myself included, were hyping up the gains from engaging in international trade, and in particular, from diversifying sales globally. Well, it seems there's a lot less enthusiasm these days. Rising protectionism, global conflict, regionalization, cynicism about institutions, politicization of trade, and a whole host of other factors have led to a lot of talk about deglobalization. The fact is, trade flows are still very globalized, and those who diversified their export sales 20 plus years ago are doing well. However, they still seem to be a small minority. The bulk of our trade is still with our traditional export customers, and not only are they slower growing nations, but we are losing market share inside of those nations to newer, faster growing emerging market entrants. At the same time, our growth is slowing, our competitiveness is slipping, and our productivity growth is sluggish. Do things need to be this way? Well, let's consider the experience of those who chose a different path. Now, this will look like a hypothetical exercise, but it is borne out in the experience of a select number of visionary Canadian exporters. To simplify, I'm going to make a few basic assumptions. First, these fictitious companies are exporters only. Second, they are only exporting goods. Third, the growth used by specific market is the 20-year average growth rate for Canadian exports in that market for all goods. And finally, the starting share of their exports is the diversification they had attained by year 2002. Okay, ready to go? Our first company did what we will call diversification light. Back in 2002, they were selling 82% of their products to the US market, not far off the overall average. At the same time, though, they sold 5% to China, 4% to Mexico, 3% to India, and the rest to other select Asian markets. Okay, fast forward to today, and based on the faster growth of the emerging market exports, the company is now selling just 59% of its output to the US, but it's selling 16% to China, 10% to India, 6% to Mexico, and 9% to the rest. Now note that even modest diversification leads to natural diversification, which actually sets the company up for more aggressive future growth. Well, the news gets even better. The company would have averaged overall growth of 3.2% annually from 2002 to 2023. This diversification actually bumped average growth up to 4.1%, and it boosted export sales 20% higher than they would have been had their export pattern been the same as the national average. Okay, so some exporters are more adventurous than that. Suppose that Company 2 sold just 2/3 of their products to the US in 2002, and 7% to each of China and Mexico, 5% to India, 3% to each of South Korea and Indonesia, and the remainder to 4 other markets in Asia and 2 in Latin America. Well, things get pretty interesting here. After 20 years, export shares shift dramatically. The US share tumbles to just 38%, while China's share jumps up to 18%, India to 13%, Mexico to 8%, Indonesia and Bangladesh to 5%, with the others making up the remaining 13%. Now that's diversification, isn't it? Average annual growth over the 21-year time frame rises to 5.3%. And by 2023, overall export sales are 50% higher than they would otherwise have been, or than for the average exporter at the shares that we saw back in 2002. Okay, so let's switch gears again. Our aggressive company 3 starts off with just over 50% of its sales to the US market, so it's already pretty diversified. China and Mexico aren't out of sight here at 10% each, and India is at 8%. So these are reasonable assumptions. ASEAN markets add a 9% share, with the remainder shared between 2 markets in each of Asia and Latin America. Well, in this case, by 2023, sales to the US would be just over a quarter of the company's total, and China would be rivaling the US at 21%. Now, not to be left behind, India would account for 16% of Company 3's sales, ASEAN for 11%, while Mexico would see a cool 10% share. With these starting shares, average annual growth would be 6% and would add a whopping 75% of extra export activity compared with what it would otherwise have been, or with the average exporter starting with average shares back in 2002. Now, some of these results may not impress. Take the growth rates, for example. Yours may actually be much higher. They will indeed naturally vary by industry. And remember, in this exercise, we are talking about Canadian averages that weathered 2 recessions. Now, what really matters here are the growth differentials. Also, nothing confines a company to these slow creeping market shares. These can, in actual practice, rise radically from year to year, especially during the early days in a market. As such, the resulting growth can be a lot more dramatic than in these cases. Now, those of you who have gone through market diversification can already see your own companies somewhere in this exercise. For those who wish you had, it's not too late. The markets used in this exercise are ones that promise strong growth for some time to come, based on how much they still have to grow to catch up to the rest of the world, and how rapidly average incomes are expected to rise in these markets over the coming decades to get them there. Don't let the gloomsters get you down. Global trade expansion is alive and well, and promises much faster growth than the status quo for some time to come. This is yet another reason that certified trade professionals will be in the sweet spot of overall economic growth in the coming decades. Go get them. We'll see you next time. I'm Peter Hall.